Live from New York City for our audience worldwide. Good morning, good morning. Following the biggest two-day pop on the S&P going back to April 2020, equities a little softer, 20 minutes away, 30 minutes away. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. We have liftoff.
We finally got the first Fed rate hike of this cycle.
These 7 hikes for this year.
All the forecasts were not particularly encouraging.
It's unrealistically hawkish what they've put out yesterday.
The numbers don't add up.
I can't add these numbers up and make any sense of them.
I don't think they believe it, to be honest.
I think of it as cloud cuckoo land.
That is true that we need to get rid of inflation.
In reality, as I think time goes by and we see the consequences of a few hikes, the growth aspect will become more real.
It's fanciful to think that we don't see an increase in the unemployment rate.
At this stage, I mean, it's easy to talk is cheap.
Inflation isn't embedded, the expectations are not embedded.
This is all fantasy land.
This is all fantasy land. Joining us now, Crossmark's Victoria Fernandez, Morgan Stanley's Matt Hornbach, Tannuzzo of Columbia Threadneedle, a fantastic panel post-Fed. Victoria, is this all fantasy land?
I think a lot of it is. I mean, Jonathan, you know my viewpoint going into this Fed meeting, and I never thought that the expectations of 7 or 8 rate hikes was going to be something that the Fed would buy into. But yet here we are. We have the dot plots that show about 7 rate hikes built into that. And you look and say, what, 2.8% by the end of next year? That just doesn't seem right. And I think the market yesterday, the reactions that we saw tell us that people were quite confused. You have a 2-year skyrocketing. You have a dollar falling. You had transports move higher. You had flows into staples increase. So it was just all these mixed messages going on. And even though I think the rally in the market yesterday was probably because we got past this first rate hike, we got past this one uncertainty of what the dot plots were going to look like, I still think there's confusion. And I agree that I don't really see this playing out the way that it was laid out yesterday. I think the Fed's going to have to end up being a little more dovish than what was planned for yesterday.
Standard Chartered agrees. They say we are less convinced on the underlying strength in both demand and labour markets, so remain sceptical that they follow through with their full hiking programme. Tannuzzo, I have to say a consensus formed pretty quickly. We heard there from Diane Swong. She said it's fanciful. Scott Minard said we're in fantasy land. Do you agree?
No, I actually don't, John. I think if there could be a headline to the Fed meeting yesterday, it should say mission accomplished. I think Jay Powell was sitting here 2 years ago, staring into the face of the biggest disinflationary force that we've seen, certainly since the great financial crisis and perhaps ever. So I think, sitting here 2 years later with a V-shaped recovery, the unemployment rate below 4% and inflation rising, it was the easiest thing in the world for them to step up and say they want to hike rates by 25 basis points. So I actually think the market response was quite reasonable. And if you look at the long end yields being stable, short-term interest rates rising because the Fed hiked rates, and risk assets doing well, I think that's mission accomplished.
Gene, that's not the bit that they think is fantasy land. The bit they think is fantasy land is not the 25 basis point hike. It's getting it to 1.9% year end, 2.8% year end 2023, and doing that with unemployment staying at 3.5% and throwing some balance sheet reduction as well. Do you think that's achievable?
Well, no, but I also don't think those are useful in terms of our investment decision making. The Fed's not in a position to predict or forecast a higher unemployment rate. There's really not a framework for them to do that. At this point, they've solved or they've accomplished the labor market objective for now, and they'll react to changes in the unemployment rate rather than really be able to influence them.
Matt Hornbach, what was your take?
Look, I agree with Gene. I think mission accomplished. I also don't think that what the Fed is suggesting they may do later this year is fantasy land. I think what's fantasy land is that people think that inflation is going to come all the way back down to earth because of some, marginal improvements in supply chains. I mean, at the end of the day, inflation is not just about supply, it's also about demand. One of the things that struck me as somewhat fanciful in the Fed's forecast is their growth forecast for this year. I mean, they've got growth coming in real terms below 3%. Morgan Stanley economists are way above that. And so we think the economy is going to be quite strong this year. I think if that ends up being the case, even with some marginal improvement in supply chains, which of course has now been thrown into question given the conflict in Ukraine, then I'd say there probably still is upside risks to inflation. And by the way, that's exactly the Fed's perspective at this point. So if they get if we get the growth that we're expecting here at Morgan Stanley, and the Fed gets the inflation that they're expecting, they almost certainly are going to hike rates at every meeting this year, and people will have to change their tune on just what fantasies they're dealing with.
Mike McKee, it sounds like we have a range of opinions here. Mike, you heard what people said to us yesterday. Matt Hornbach, Gene Tannuzzo taking the other side of it. Mike, all signs are that this is a strong economy. Chairman Powell's words. We do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Yeah, well, we're watching the Fed chairman, and we're going to be watching the economy and see how their forecasts turn out. But I want to start by taking you back home, across the pond to England, where the Bank of England today raised interest rates for the third time in a row. They're walking the walk that the Fed is talking. But take a look at the top line there. That's inflation expectations. They're raising rates and expectations are still going up. Governor Andrew Bailey is seeing what Jay Powell does not want to see, which may be something that is behind their forecasts. Take a look at what they are talking about, and you've gone over the numbers pretty well. Unemployment's not going to rise, GDP's not going to fall below potential, and inflation is going to magically come down. I'm not calling it Fantasyland, I'm calling it Alice in Wonderland. The Fed funds rate is going to go above neutral, and all of this is going to happen. It may be more performance art than anything else. The Fed doesn't know what's going to happen down the road because of the war, because of COVID. That's not over with. And so they're going to overpromise to keep the markets from getting over-concerned and try to keep those inflation expectations anchored. And then they'll see down the road if they need to do 6 or 7. You take a look at the dot plot, and you can see how it has moved over the last 24 hours to the right there and higher. The light green line is where the market thinks rates are going to be if you look at overnight index swaps. And so the Fed has positioned itself even more hawkish than the market at this point. But what you look at is, on those white dots, the big spread in 2023 and 2024 shows the Fed is not at all united on what needs to be done. So there's a long way between here and getting everything that we saw in their forecasts. And the Fed may not go that far, but they, at this point, want to control the narrative.
Mike McKee, thank you. Let's talk about how to push this through the bond market, the yield curve. Victoria, 2s, 10s, the spread between the two, 22 basis points. 7-year yields are above 10s. 5-year yields aren't far behind, and neither are 3-year yields early this morning. Are we facing some curve inversion through the next couple of months?
Well, I mean, and we've got a little bit of it already. And even yesterday during the press conference, you could see some of those inversions happening. So do parts of the curve invert? Yes, I think they do. And so that's when you have to really start looking at where are you buying? You have your duration call in your fixed income portfolios, but where on the yield curve do you want to be, right? That's part of our investment process for our fixed income portfolios. But clients keep asking us about that. What happens if the yield curve inverts? At our investment committee meeting last week, we actually sat down and said, let's forget 2s to 10s. Let's look 3-month to 10, because that's where we think you really get some of the technical movement when it comes to recessions following an inversion. You look a week and a half ago, that was around a 140, 145. This morning, it's 170. You actually got steepening in the 3-month to 10-year part of the curve, which I think is quite interesting as you get everything else flattening. So there's some confusion, in my opinion, in what's going on in the yield curve. I think we need to give it a little bit of time to flatten out, but I will tell you we are extending duration a little bit right now. We've been short for a long time because we do think that 230, 240 range is probably going to be the peak, regardless of the news that came out yesterday. I think you're looking around 230, 240 on the 10-year before we start to see yields coming back down.
Matt Hornbach, your reaction, sir?
Well, we very much are in the flatter curve camp, John. I think this curve is ultimately going to end up inverting by more than we have seen certainly in my career, and I would argue for probably a couple of decades even before I joined the business. I think we're going to end up seeing a much flatter yield curve, John. And ultimately, it's not going to come by way of conundrum, right? This is not the 2004 to 2006 experience when we had a tremendous amount of capital inflow into the U.S. weighing on longer term yields. This is really a combination of some overseas demand, yes, but you've got tremendous central bank balance sheet stock here that's weighing on the long end of the curve, and we've got solvency ratios in the pension fund industry that keep going up, John. So you're going to have a tremendous amount of demand for the back end of the curve. It's going to end up flattening the curve quite a bit, I think.
Gene, final thoughts?
I think that's right, and Victoria said it very well. There really is a lot of positive slope still in the curve. If you think about, the Fed funds rate at 40 basis points and the 30-year at 240 basis points, there's a lot there. But we have to remember that it's only been really about 10 years that the Fed's been giving us these summary of economic projections, or the dots. So all of a sudden, those first 2 years have a lot more clarity. And so when we start to look at things like 2s, 10s, I don't think it gives us the reliable signal that it gave us before. But as we go forward, the Fed indicated a pretty consistent path of hikes. It's hard to see the curve not flattening in that environment.
Gene Tannuzzo sticking with us alongside Victoria and Matt. About 20 minutes away from the opening bout. Let's get you some movers. We can do that with Abby.
John, well, after the best 2 days for the S&P 500 since April of 2020, as you mentioned, today we're taking a little bit of a breather. U.S. futures are lower and in a broad-based way, leading the way to some degree. And from a point standpoint, Apple coming in after a 7% 2-day rebound rally. That for the NASDAQ 100, but Apple a big piece of it, and that's the best for the NASDAQ 100 since November of 2020. The travel trade unwinding too, with with oil popping back above $100 per barrel. United Airlines down 2.5%, and the banks with yields in just slightly, weighing on the banks, down 6.1%. And then there's Warby Parker, the eyewear retailer, is plunging, although off of its 20% pre-market lows. This, John, on a net revenue miss and weak forecast. There is one sector higher. We'll be talking about it later. That is energy.
Looking forward to that, Abby. Thank you. With that big move in crude again today. Coming up, Russia denying reports of major progress in peace talks.
The Russians, for all the talk about wanting to find a diplomatic path forward, we haven't seen them act on that.
That's next. This is Bloomberg.
The Russians, for all the talk about wanting to find a diplomatic path forward, we haven't seen them act on that. What you're seeing by the Russians on the ground is a full-on commitment to military operations. The fighting continues, the death and destruction continues.
Mixed messages, loads of them emerging amid talks between Russia and Ukraine. The Financial Times reporting the following in the last 24 hours. Ukraine and Russia have made significant progress on a peace plan, including a ceasefire, Russian withdrawal if Kyiv declares neutrality and accept armed force limits. The Kremlin denied the report. They said the following: on the whole, that's wrong. When there's progress, we'll tell you. Team coverage starts right now. Anne-Marie down in D.C., Maria Tadeo in Brussels. Maria, great interview with John Kirby earlier this morning. Can you tell me where we are in these talks right now?
Well, you heard it right there. He did say the words coming out of the Russian Federation do not match the actions on the ground from the Russian Federation. We continue to see a huge military deployment in Ukraine. We continue to see cities that get bombed and shelled every day. Yesterday, there was a big operation in the city of Mariupol. Remember, this is the place that connects Crimea to the Donbass, and it's a major, major fighting ground for the Russians, and that continues. He also made it clear that for Ukrainians, they want to see a ceasefire before the real talks begin, and that ceasefire is nowhere to be seen. When it comes to the troop pullback, it's been the opposite. Russia continues to engage not just men on the ground, but also, remember, Jonathan, the real damage is being done from the sky. It's aircrafts, it's fighter jets that continue to bomb the crowd of Ukrainians. So a lot of this, of course, you could talk about talking neutrality and so on, but on the ground, this is still a war that's going on for 22 days.
AMH, really important talks tomorrow. They don't involve Russia or Ukraine. It's the President of the United States with Xi Jinping of China tomorrow. How important is that?
I think it's incredibly important given the fact that the United States is trying to get China on board to influence President Putin. This also comes after a number of reports we have that Russia is seeking that help from Beijing, one on the military front, but also on the sanctions front. They want us to be able to do trade and business with China. It also comes after that high-level talks between Jake Sullivan and his Chinese counterpart in Rome that really is setting the stage for these talks. But now you have leader to leader. And Jonathan, they haven't spoken since November. So this is an incredibly important call for the president to make sure and to attempt to try to get China on side with the United States, because China, of course, is not there from a straight up diplomatic on the surface level, but also the undertones of potentially are they going to come to Russia's rescue?
MH, thank you. Down in D.C., Maria Tadeo over in Brussels. Crude this morning up 7% on Brent, just short of 105. On WTI, through 101. 101, let's call it 50, up 6.7%. Morgan Stanley with their forecast at 120 for crude, 120 in the third quarter. They say the following: to say that oil prices have been volatile recently would be an understatement. It will likely become progressively more difficult for Russia to maintain its seaborne exports in the coming months. Victoria Fernandez, have we fully realised the risks associated with this story? And what would you look for to give you confidence that that's the conclusion?
Yeah, you know, Jonathan, we were underweight energy last year, which from a market perspective did not work out well for us. But we were adding some in the beginning of the year, and that was good. But we've started to trim because there is so much uncertainty going on there. Is it fully priced in? Have we appreciated all of it? Probably not. I mean, the question is, you've got tankers on their way here already with Russian oil. Do we close the ports to them? What happens then to the companies that have paid for that, and then the tankers sit out in the ocean, and what do we do with that? You have Russian oil that is going to be priced so cheaply that do companies still continue to turn a blind eye to that because of political issues? I just don't know how this is going to work out. There is such tremendous volatility. We spoke a couple weeks ago and we thought, oh my goodness, oil could get to $100. And then it got to what, 130, 140. And now we're back again right at 100. That's a lot of movement going on there. We knew there would be volatility in this sector. I don't think we knew it would be quite this much. I would be very cautious here until we see things play out a little bit more. This meeting with China, I think, plays into this as well. How much is China going to step in and help with Russian oil and taking some of that that volume there? I just don't have an answer to it right now, but our suggestion would be to be cautious.
Tomorrow is an important conversation. Matt, can I come to you on that question too? If you remember COVID and coming out of the pandemic, even in the pandemic, at some point this awkward transition evolved, and I think it is awkward. The market starts to live in a better future, hoping for one anyway, even with the devastation that continues right in front of our faces. How would you identify when a market is starting to move past a tragedy like this one?
I mean, John, it's a wonderful question. I don't know if there is one answer to that. I mean, at the end of the day, time tends to heal all wounds, but again, it kind of depends on how big the wound is. At the end of the day, what we're looking for, John, is signs that the increase in prices that you see for energy, ultimately that end up affecting consumers. You know, to what extent do those incomes that consumers are bringing in through either new jobs or just general increases in wages? You know, how do they deal with that? You know, are those increases in wages enough to offset the higher prices at the pump? I mean, these are important things, and there is uncertainty around this, John, which is, I think, ultimately why you see a lot of disagreement or at least uncertainty in the Fed's projections for policy this year.
Gene Tannuzzo, the lack of visibility and clarity about the year ahead, is that a big topic of conversation where you sit?
I think it is, absolutely. And I think we have to remember here, John, tightening is happening right now besides just the Fed funds rate, right? So we know the short-term interest rate has risen, but lost in this debate about whether the Fed should hike 25 or 50 basis points is the fact that we'll also see the balance sheet start to run off probably at the next meeting. We're also seeing financial conditions tightening, and we're also seeing the biggest fiscal drag that we've ever had in this country post-war. So I think the drags on growth are real. And when you talk about these shocks, whether they be from Russia and Ukraine or perhaps what could come if things got bumpy with China. Those shocks are real, and I think are things that the Fed is going to have to deal with, perhaps in the second half of the year when there's not quite so much economic momentum.
Gene, you said something so important 10 minutes ago about the summary of economic projections. Not only did we used to get by without that, we didn't have a news conference, we didn't have a statement. When that was introduced, it was introduced to help ease, to help reinforce forward guidance. It was as if to say, look where we think rates will be for the next few years. They're going nowhere. Price that in. Then when we started to embark on tightening cycles, what developed, as you know, Gene, is that we used to take the dot plot, front load the rate hikes, financial conditions would tighten and the Fed would have to back away before they could do any of that. Do you think this time is somewhat different?
Well, I think we have to remember how the Fed affects financial conditions, right? Essentially, they can affect, forward guidance is a very powerful tool through which they can influence financial conditions. The dots are a very important communication tool for their forward guidance, but the dots are much, much more effective as an easing tool than they are as a tightening tool. So as we're trying to price in additional hikes, it's really just a summary of the current state more than it is, I think, an accurate projection of where yields must go in the future. Look, we realize that inflation is high and the unemployment rate's low. So those dots that you see on the screen are the projection you have to have given the state of the economy as it sits today.
Gene Tannuzzo, Victoria Fernandez, Matt Hornbach, sticking with us through the opening bell, I'm pleased to say. Coming up in the morning calls and later, JP Morgan, Bank of America Citi, pairing gains after surging on the Fed's rate hike and the move we saw in yields yesterday. JP Morgan down about 0.5%, B of A off by 0.4, Citi down by a similar amount. The opening bell just around the corner from New York. This is Bloomberg. Five minutes away from the opening bow, 2 days of gains. We pulled back a little bit, down 0.4% on the S&P 500. Fascinating moves in the bond market, 2s, 10s and 30s. 10s last Thursday, lower the session, 190.96. Look where 2s are now. 2s are above where 10s were just last week. 2s right now, 193.44. And the spread between the two, about 22 basis points through much of this morning. It's got tighter and tighter over the last few weeks. Year to date, much more so. We've gone from 70 at the start of the year all the way in to the low 20s and had a little look at 18 earlier on. That's the price action here in the morning calls. JP Morgan upgrading Ralph Lauren to overweight, seeing the company's regional revenue mix offering relative brand insulation. Wedbush raising its price target on Williams-Sonoma to 200, noting the company reported fourth quarter results that handily beat on the bottom line. And RBC downgrading Union Pacific, seeing the relative volume performance gap narrowing on near and medium term factors. Up next, the opening bow with a big focus on the big banks. The biggest two-day pop on the S&P 500 going back to April 2020, and we pulled back just a little bit on the S&P, negative 0.5% on the Nasdaq. A similar move, down 0.6 on the Russell, down 0.5% as Russia pushes back against this idea. We've had a major breakthrough in talks. They say the report from the FT is, quote, wrong. That's the opening bow. Switch up the board and get to the bond market. What a move we've seen on 10s, on 2s as well. Your 2-year yield much higher than where it was at the start of the year. The last time the Fed met, 115 at the close. Yesterday, it came very close to 2% on a 2-year. The 10-year down to 215 this morning, down a couple of basis points to 215.63. Euro dollar punching back through 110, 110.62, up 0.25% on that currency pair. And look at crude go, up more than 7 percentage points to 101.83. Around the opening bow, 25 seconds in. Here's Abby.
John, we of course are looking at a little bit of a consolidation of that big 2-day rally being led by some of the mega cap tech names, including Amazon. Not in a big way, but again, the point constitution to the indexes is what counts, down 0.6%. Tesla down 0.9%. That amid news that they have halted a bond sale backed by auto leases with all of the market turmoil. And I should note Amazon, they have actually closed that $8.5 billion MGM acquisition in the race for content in the streaming wars. But you were talking about energy. There it is. ExxonMobil up 1.8%. Occidental Petroleum up 5.1%. Energy, one of two sectors, as you know, higher. The rest are lower, John.
Abby, the big winners of the session, the big winners of the year so far. The big banks reversing some big gains off the back of a more hawkish Fed. For more, I want to bring in Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the banks are declining today, and I would point out they've been declining for a large part of the year so far. Through Tuesday, the KBW Bank Index was down by about 5%, but it did reverse a good deal of those losses yesterday post-Fed decision. It was up 3.6%, so cutting those losses down to about 1.5% on the year. When you look at one stock like JP Morgan, it was up 4.5% on the day yesterday. Its best day since January. The reason why, pretty straightforward, John. Banks generally consider beneficiaries when rates are higher because they can charge more for what they lend. And not only did the Fed raise rates yesterday, it signaled many more hikes to come. In fact, potentially 6 more this year and more the year after, ultimately getting to 2.8% by the end of 2023, if you believe the dot plot. So in theory, that should benefit the banks when it comes to net interest income, which is the primary revenue source for most of the major players. It's 58% of revenue for Citi. It's roughly half for Bank of America, Wells Fargo, and JP Morgan. Obviously less important for investment banking focus, Morgan Stanley and Goldman Sachs. But the point is, higher rates should help out the fundamentals for these companies. The question is, John, at what point do higher borrowing costs actually hurt demand for loans and start to turn things in the other direction, John?
Kaylee, that's the US. In Europe, they've got other problems, bigger problems. And you know what that begins with? Russia. This was the line from Intesa Sanpaolo yesterday that Russia-Ukraine loan exposure totaled about 5.1 billion euros. Moments ago, Intesa said this, the CEO signaling the 22 profit goal is at risk after the invasion. Going on to say, though, that they have no plan to postpone the 22 share buyback. So that's just come from the Intesa CEO moments ago. That stock just a little bit softer on the session so far. Let's go back to the financials in America. Larry Adam of Raymond James said this. One of the catalysts is interest rates moving higher, and that's going to help lift the expectations of what the sector can produce from an earnings perspective. Victoria, I want to come to you on that. There's two things at play here. I think the 10-year kind of sets the tone for how investors allocate towards the financials, but when you're talking about profitability, isn't it somewhere else?
Yeah, well, I mean, you have to look at the shape of the yield curve. We were talking about that earlier, and as that gets flatter, you want to look at that difference between the short end and the long end, and that comes into play a lot more for banks than probably just the 10-year rate by itself. Saying that, though, you know financials are one of our favorite sectors so far this year, and last week and even earlier this week, we were adding to some of those names. We were adding to Bank America, we were adding to Visa and MasterCard, because I do think we're going to continue to see some improvement in these names throughout the year. Obviously, yesterday was a really strong day with what we saw out of the FOMC meeting. But even going forward, I know Kaylee talked about loan growth, and is that going to dampen with consumer sentiment coming down? We don't think so. We think we're going to continue to see loan growth continue. You look at household balance sheets with revolving debt, and there is plenty of room for the consumer at the consumer level to go in and do loans and increase their debt as well. You've got really strong balance sheets for these banks. And I mean, you look at Bank America, there's a 2% dividend yield there. So I think they're sitting in a pretty decent position. Now, again, this is US banks, not European banks. That's a different story. And you look at where they sit in regards to the Russia issue. Bank America is pretty good in that situation. We know Citi had some exposure. You also have to look at counterparty risk in regards to commodity futures, and Bank America sits well there. Morgan Stanley is probably one that has a little more issues. So for the sector overall, we're pretty confident for them going forward.
You like the banks, and the reason you like the banks is usually the reason people don't like big tech. Dan Ives of Wedbush said this yesterday following the Fed call. He said, in a nutshell, we believe the tech sector is as oversold as we have seen in the last 5 years, and we would strongly be buying cloud software, cybersecurity, chips, and stalwart tech names here led by FANG, with Apple and Microsoft our clear favourite large caps. There is one view, Victoria, shared by some, that the Fed can't get much more hawkish than this. They've implied what they can do, 1.9% year end, 2.8% next year, balance sheet reduction. And for that reason, given what's happened with tech already, buy. What do you say?
I don't disagree with Dan at all in his statement. I mean, we've actually been adding to our Apple and Microsoft positions, buying some other tech names, because we do agree that that sector has been oversold. And you don't want to have zero growth exposure, zero tech exposure in your portfolio. So you look at those names that have come down significantly, 15, 20, 25% year to date. I think you go in and you have that opportunity. You buy those names and put them in your portfolio. Dan mentioned Apple and Microsoft, and I said those are two names we actually have bought over the last couple of weeks. So I think you use it as an opportunity for exactly those reasons.
Jean, allow me to play devil's advocate. We've got a yield curve that a lot of people think will invert. Matt's talked about that earlier this morning already. Consumer confidence, shaky. A Fed that's going to try and reduce the balance sheet quickly, more quickly than last time around. Interest rates higher and higher potentially than last time around. Why do I want to own risk assets in that world?
Well, look, we have to remember those growth headwinds are there. So I don't think we have a free pass to add risk across the board in portfolios. But we've had a significant repricing in the last 6 months. And the example I would use is U.S. investment grade credit, particularly at the long end of the curve. We've had spreads widen materially at a time when yields have risen as well. So you've had investment grade long duration bonds down 15% or so in the last 6 months. We think this is a buying opportunity when the Fed is giving us some comfort that the long run dot is in the realm of where the 30-year Treasury yield is at this point in time. Credit spreads are wider, and these are the companies with the strength of balance sheet that in the fullness of time will do well through this cycle, as opposed to the riskier, high yield, highly levered companies.
Jean, any particular industry groups within IG that you prefer? Anything there at all?
Yeah, Victoria brought up the banks, and actually in fixed income land, they're particularly attractive right now. I would say more than they have been in a long time. A lot of that is not because of fundamental weakness, but because of the supply and the technical picture. There's been a lot of new issuance. And so that's really pushed the sector wider, I think, for reasons that are temporary in nature.
Matt Hornbach, you wrote about the hedging properties of the long bond, and we haven't touched on that much this morning. Can you go there now, Matt? Can you talk to us about why that might be the place to be?
Yeah, well, John, one of the things that we've been following for some time now is the increase in funding ratios for the U.S. corporate defined benefit pension plan community. And one of the things that Gene alluded to in his comments with the increase in long-term interest rates, the widening in credit spreads, that has actually boosted the discount rate for corporate pension liabilities. And so even though there's been a little bit of weakness in the equity market since the start of the year, you've actually seen these solvency ratios continue to march higher for corporate pension plans. And so ultimately, this is putting them in a really good position to de-risk their portfolios. Now, this is not something that they're going to do at one point in time and then never do again. There is a glide path here that a lot of pension plans follow. But at the end of the day, as long as that funded status continues to improve, you should continue to see demand coming out of the equity market into long-dated fixed income for that particular community of investor. And that's in addition to the large stock of securities that the Fed has removed from the marketplace. So that's one of the core features of a curve flattener that we've been advocating for some time now.
Matt, how do you think the curve's going to respond to the eventual balance sheet roll-off we're looking for, the QT, so to speak, in the coming 18 months?
Well, John, I think what is the consensus expectation for that process, which is a passive process, is more or less in the price of the bond market already. I mean, there may be some slight, kind of differences in people's opinion over the specifics of the program. Where will the caps be set? How quickly will the Fed get to those caps? When exactly are they going to start the program? Gene suggested May. We think that's certainly within the realm of possibility. So, there's some differences in people's views there, but by and large, everybody knows it's going to get going by mid-year. And so that's more or less in the price. What's not particularly in the price is if the Fed decides to sell securities at some point later this year, that would not be in the price. And then you would see the yield curve respond to that.
Matt Hornbach, great work as always, buddy. Good to catch up. Victoria Fernandez, June Tannuzzo, thank you to the three of you. This is a really tough moment to make a call on what outcome we're going to get. Aaron Kennan at Clear Harbor wrote me a message yesterday on Twitter. He said the following: the dilemma for many investors at the moment, allocate capital towards the inflationary picture or allocate to the increasing likelihood of lower growth and incrementally higher unemployment. I suspect the likely outcome is higher vol and lower valuations for now. a range of opinions. There's one. I'm looking forward to catching up with Aaron a little bit later through the next month or so. Coming up, President Biden ramping up military aid to Ukraine.
Now I'm once again using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault.
That's next. This is Bloomberg.
Now I'm once again using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault. An additional $800 million in assistance. That brings the total of new U.S. security assistance to Ukraine to $1 billion.
President Biden expanded the arsenal for Ukraine as Ukraine's leader pleads for more aid, more military aid, and more sanctions. Those sanctions are already hitting Russia. The default countdown kicked off already this week. The bond payment is still in limbo from yesterday, 2 interest payments, about $117 million. Bloomberg's Mark Dowding said this: expect the pain to last. Russia will be in the isolated wilderness for a long time to come. A regime change is probably a prerequisite for reinvestment, along with lifting sanctions. Damien Sassar of Bloomberg Intelligence is back with us. Damien, go on the reporting and let's work out what's happening here. Have they sent the money over towards the investors and through the bank?
So my understanding is that Finance Minister Sulanov, Russian Finance Minister Sulanov, did indeed send the dollars to his correspondent bank for payment on to Citigroup of London, who is the payment bank that has to make payment to creditors. We've heard nothing from Citigroup. We don't know if they've actually taken in that money, if they're actually going to pay that money. We know that Citigroup's back office has had some issues in the past. Revlon, for example, they made an erroneous payment, about a year ago. But that's neither here nor there. The reality is we just don't know if they're able to make those payments. We don't even know if they've received them at this point. But let's just say, for all intents and purposes, Jonathan, that they have received the money and they're going to pay the creditors. Well, then we look backwards and forwards. We look backwards to March 2nd when Russia defaulted on its OFZs, its local debt. And assuming what Fitch says, there's a 30-day grace period on that, unconfirmed. That takes us through to April 2nd, and that may constitute a default. And we all look forward to April 4th, when $2 billion of principal are due on Russian bonds. And so, yeah, the game goes on, and it's just like a shell game here,
This
Jonathan.
can get messy quickly. We don't know if Russia sent the money. We won't have confirmation of that until the corresponding bank can actually say we've received the funds. We have to take their word for it. Some people might be unwilling to do so. Can we go on the theory just for a moment, Damien? Theoretically, can the corresponding bank accept that money from the Russian sovereign?
I mean, I don't know. I mean, look, they can if they get special dispensation. If the government, I mean, this is kind of what's going on here. If the government allows them to receive it, yes, they can, right? But, I mean, according to everything we're reading, everything we're seeing, they're really not able to receive, they're not able to transact with Russian banks. They're not able to transact. So, the verdict is still out, Jonathan. I mean, if you look at some of the, corporates that have paid, Gazprom, Rosneft, they actually had to receive dispensation from the Russian government in order to move those monies to their creditors. So, there are two sides of this coin, and far be it for me to opine either way. It's just a matter of wait and see, and at this point, we just don't know.
Can I just get some additional clarity as well, Damien, as to whether they did pay that in dollars? You indicated they did. They threatened to pay in local currency.
Yes.
Are they saying they've sent that money in dollars?
Finance Minister Sulanov is absolutely saying that they have every intention of making that payment in dollars. That's a key point because these bonds don't have the fallback optionality where they can pay in rubles.
So how many days left? 29, 28?
29 and counting.
Wait and see.
Yeah.
Do you think we fully realise the consequences of what happens once that grace period passes and perhaps the money doesn't turn up?
Well, Jonathan, I mean, this is a good question because, I think the default is kind of baked in at this point. It's really what's the real economic impact? I mean, don't get me wrong. There's a lot of offshore creditors that are already marked those bonds down, and they're going to get into a restructuring, a very complex restructuring in order to see just what the recovery is. I think Blue Bay, Mark Dowding actually estimated something in the order of, 25 to 40% recovery when all is said and done. But timing is everything. How long does it take for them to recover, their investment? That remains to be seen. So look, I mean, we're sort of in limbo still.
Damien, throw in China as well. Can you tell me how isolated this story is at the moment within EM? Has it started to bleed out?
So
we're seeing waves, ripples.
So no, we are. I mean, look, if Russia's been kicked out of all these bond indices, right? So that means two things. who's going to take the place of Russia in these indices. So going forward, high-yielding emerging markets like perhaps Egyptian local bonds or Indian local bonds, both of which are being added to bond indices, or that process is ongoing as we speak, they should benefit from this. Also, forward, and on the flip side, those EM local debt markets that are most liquid, most heavily weighted in indices, China, Indonesia, and Thailand, are most at risk because if you can't sell your Russian bonds to meet your redemptions, you're going to sell the most liquid stuff in your portfolio, and that's CGBs, Indonesian government bonds, and Thai government bonds, and so forth.
Damien, we've got a lot of work to do through the next 28 days or so, and you're going to make it easier for me. Good luck to you. Yeah. Damien Sassoon there of Bloomberg Intelligence. Let's keep it on China, allowing some companies to restart factories amid lockdown in Shenzhen. When is a lockdown not a lockdown? And do lockdowns always look like lockdowns did back in 2020? Paul Donovan of UBS taking issue with that, saying the problem is that people hear lockdown and instinctively think of what happened in 2020. That is not what is happening now. Let's get back to Abby for more. Hey, Abby.
Hey, John. Well, you know, this is really interesting because, of course, on Monday, the sky was falling. 51 million people in China were locked down, and the interpretation was that it was a hard 2020-style lockdown, whereas now it seems as though it's loosening up in terms of what's happening over there as far as what it might mean. And there's a piece of this is the fact that new confirmed cases have actually dropped for a second straight day. On Monday, they were up fourfold over a week, so now it's going in the right direction. And in fact, one Hang Seng economist expects the factory closures in the south and in the north to be just 2 weeks as opposed to what felt like it could be for a long time and really influence the economy. And in fact, that important Foxconn, partially they've resumed some of their Shenzhen production. I don't know if that includes the iPhone plants, but it may. So it seems as though there's some hope for the China economy around these new lockdowns. That could be a reason for why we have this monster rally, historic rally for many of the China indexes. That CSI 300 over the last 2 days up 6.4%. The Hang Seng up nearly 17%. Hang Seng Tech amazingly up 32%. Today, though, taking a little bit of breather. That makes sense because, of course, yesterday, that Golden Dragon index here in the U.S. up 33%. Its best day ever. I can't ever remember an index being up 33% in one day. So today, some consolidation. But on the other hand, John, oil, as you know, right now at $101 per barrel, above $101 per barrel, up 6.3%. That probably reflects some hope that the China economy is not going to be hit quite so hard by these lockdowns.
This ADR story as well. We have not sorted out that audit issue, have we, Abby?
You know, it's really incredible, this volatility, both to the downside and the upside. I would say that the really key point to think of here, though, is that these stocks down 75%, then that monster rally, they barely made up any of those losses. A lot of folks are telling me that it's like catching a falling knife. In fact, I spoke to Paul Ciano over at Bank of America, and he was saying that people really aren't reaching out yet because of that risk. But let's see what happens here. It's pretty interesting, but it's going to depend on these fundamentals, plus the important issue of where China falls on the Ukraine-Russia war.
Abby, thank you. Headline roulette is never an enjoyable game, is it, when it comes to Chinese policymakers? Their intent is important, always is. Can it change the other way quickly, though? I'll let you decide. The Hang Seng up more than 7% at the close. The CSI 300 up about 2%. With your sector price action for today's price action, 22 minutes in, here's Kriti Gupta.
Well, good morning, John. Of course, you are seeing some divergence in the markets right now about flat in the S&P 500, but it's really because you don't have tech on your side. In fact, tech weighing the entire market down. What isn't weighing the market down is energy. It is up, and it is up by a lot, up 1.7%. And if you look underneath the hood, once again, it comes down to those favorites, the energy companies that have that extra exposure to U.S. production. Occidental, Marathon Oil, Halliburton, and Occidental getting an extra bid. It's actually your best performer at the moment after some reporting that Warren Buffett is now building his stake up in the stock. 14.6% of the company is just how much he owns right now. And this is really important because, of course, we know that financing for the Anadarko deal came partly from Warren Buffett. And nevertheless, it kind of seems like other investors are taking his lead and really boosting those energy shares, John.
Kriti, thank you. Kriti Gupta on the sector price action. A move on Brent. Brent crude 105, WTI 101. Let me leave you with this one just quickly from Citi and Andrew Hollenhorst. Investors should heed this warning and expect the Fed to continue to raise rates and engage in balance sheet reductions until some combination of higher real rates and lower risk asset valuations are achieved. We expect a 50 basis point hike in May and the announcement of balance sheet reduction as well. The line from Citi this morning. Up next, your trading diary. This is Bloomberg. about 5 minutes' time, Guy Johnson, Gina Martinan's picking up on a price action for you, trying to explain the last few days. We're unchanged now on the S&P, on the Nasdaq down about 0.1%. That's the price action. Here's the trading diary. Picking things up with Secretary Blinken speaking on the war in Ukraine at 1:30 Eastern. President Biden and China Xi talking Russia tomorrow. That is a really important conversation. More central bank decisions on deck with the Bank of Russia and BOJ+. We'll hear from the Fed's Barkin and Bauman. The Fed speak, no doubt, will continue next week. From New York City, this was the Countdown to the Open. This is Bloomberg.